Welcome to episode 5 of the MLO Exam Prep Podcast. This episode is all about mortgage loan calculations, an essential part of your exam and your career as a mortgage loan originator. We'll cover loan-to-value LTV and combined loan-to-value C calculations, debt-to-income DTI calculations, periodic interest rate and per diem interest calculations, how to calculate PITI payments. These formulas are fundamental to mortgage lending, so we'll ensure they're presented in a way that's easy to remember and apply on the test. Let's get started. Loan-to-value LTV and combined loan-to-value CLTV calculations. Loan-to-value ratio, LTV. The LTV ratio represents the relationship between the loan amount and the lesser of the property value or purchase price. Formula: loan amount divided by lesser of the property value or purchase price equals LTV ratio. Example: a borrower is purchasing a home for $250,000 and is making a $50,000 down payment. First, calculate the loan amount. $250,000 minus $50,000 equals $200,000. 2. Now calculate LTV. $200,000 divided by $250,000 equals 80%. Final LTV, 80%. Exam tip: a lower LTV indicates less risk for lenders. Borrowers with high LTV ratios may be required to pay mortgage insurance. Combined loan-to-value ratio, CLTV. CLTV includes all mortgage loans on a property, including first and second mortgages. Formula: first loan balance plus second loan balance plus all other lien balances divided by lesser of the property value or purchase price equals CLTV ratio. Example: a borrower has a first mortgage of $180,000 and a second mortgage of $40,000 on a home valued at $300,000. 1. Add all loan balances. $180,000 plus $40,000 equals $220,000. 2. Divide by property value. $220,000 divided by $300,000 equals 73.3%. Final CLTV, 73.3%. Exam tip: CLTV is higher than LTV when a borrower has multiple mortgages on a property. Debt-to-income ratio, DTI calculations. DTI ratio. The DTI ratio helps lenders determine if a borrower can afford a mortgage based on their income and existing debt. Formula: total monthly debt payments divided by gross monthly income equals DTI ratio. Example: a borrower has a gross monthly income of $6,000 and the following debts: mortgage payment, $1,500, auto loan payment, $400, credit card minimum payment, $200. 1. Add all debt payments. $1,500 plus $400 plus $200 equals $2,100. 2. Divide by gross income. $2,100 divided by $6,000 equals 35%. Final DTI, 35%. Exam tip: most lenders look for a DTI of 43% or lower for qualified mortgages, QMs, periodic interest rate, and per diem interest calculations. Periodic interest rate. The periodic interest rate is the annual interest rate divided by the number of payments in a year. Formula: annual interest rate divided by number of payments per year equals periodic interest rate. Example: a borrower has a 6% annual interest rate on a mortgage with monthly payments. Divide annual interest rate by 12. 6% divided by 12 equals 0.5% per month. Final periodic interest rate, 0.5% per month. Exam tip: understanding periodic interest rates is key for mortgage payment calculations. Per diem interest, daily interest charge. Per diem, or daily interest, is calculated by 1. Multiplying the loan balance by the annual interest rate. 2. Dividing by 365, or 360, depending on lender requirements. Formula: loan amount multiplied by annual interest rate divided by 365 equals daily interest charge. Example: a borrower takes out a $250,000 loan at 5% interest. 1. Calculate annual interest. $250,000 multiplied by 5% equals $12,500. 2. Divide by 365. $12,500 divided by 365 equals $34.25 per day. Final per diem interest, $34.25 per day. Exam tip. Per diem interest is collected at closing to cover the days between loan funding and the first payment. Principal, interest, taxes, and insurance payments. PITI components. 1. Principal and interest, P&I, loan repayment plus interest. 2. Taxes, property taxes divided into monthly payments. 3. Insurance. Principal, interest, taxes, and insurance payments. 1. Principal and interest, P&I, loan repayment plus interest. 2. Taxes, property taxes divided into monthly payments. 3. Insurance, homeowner's insurance divided into monthly payments. Formula: monthly principal and interest plus monthly property taxes plus monthly homeowner's insurance equals PT payment. Example: a borrower's loan has a P&I payment of $1,200. They also pay $3,000 annually in property taxes, $1,200 annually for homeowner's insurance. 1. Calculate monthly property taxes. $3,000 divided by 12 equals $250. 2. Calculate monthly insurance. $1,200 divided by 12 equals $100. 3. Add all components. $1,200 plus $250 plus $100 equals $1,550 PID. Final PIDI payment, $1,550 per month. Exam tip: PD is used to determine affordability and qualify borrowers for a mortgage. Closing thoughts on Part 1. We've covered key mortgage loan calculations that you must know for the exam. In Part 2, we'll move on to loan estimate LE and closing disclosure timing rules, escrow statements and servicing transfer notices, TILA and RESPA disclosure requirements. Stay tuned. Welcome back to Episode 5 of the MLO Exam Prep Podcast. In Part 1, we covered mortgage loan calculations, including LTV, CLTV, DTI, periodic interest rates, per diem interest, and PIDI payments. Now, in Part 2, we'll focus on mortgage loan disclosures, specifically loan estimate LE and closing disclosure, CD timing requirements, escrow account disclosures, servicing transfer notices. These disclosures protect borrowers by ensuring full transparency in mortgage transactions. Let's get started. Loan estimate and closing disclosure CD timing rules. The loan estimate LE. The loan estimate is a key disclosure required by TILA under the TRID rule. It provides borrowers with clear details about loan terms, closing costs, and monthly payments. Other timing requirements. The loan estimate must be delivered or placed in the mail within 3 business days of receiving a completed loan application. A completed loan application includes 1. Borrower's full name. 2. Social Security number. 3. Property address. 4. Estimated property value. 5. Loan amount requested. 6. Borrower's income. Exam tip. A test question might ask, when must the loan estimate be provided? The correct answer is within 3 business days of receiving a completed loan application. Closing disclosure. The closing disclosure, CD, is a 5-page document that provides final loan terms, closing costs, and the total cash needed at closing. CD timing requirements. The closing disclosure must be delivered to the borrower at least 3 business days before closing. Exam tip. If a question asks, how long before closing must the CD be provided? The answer is at least 3 business days before loan consummation. When is a new loan estimate or closing disclosure required? A new LE or CD is required if there is a valid change of circumstance that affects loan terms. A valid change of circumstance includes interest rate changes after a rate lock, loan product changes, increase in settlement charges beyond tolerance limits. Exam tip. If a borrower requests a loan product change or interest rate lock, a new loan estimate must be provided within 3 business days. HAT escrow account disclosures. Initial escrow statement. Due at closing or within 45 days after closing. Details property taxes, homeowner's insurance, and mortgage insurance payments held in escrow. Annual escrow account statement. Servicers must send this every year to show the borrower's escrow balance and payment adjustments. Exam tip: expect a question about escrow statements. The initial statement is due at closing or within 45 days. Servicing transfer notices. Servicing transfer disclosure requirements. RESPA Section 6. If a loan servicer transfers the servicing of a mortgage, borrowers must be notified. Timing requirements. Current servicer must notify the borrower at least 15 days before the transfer. New servicer must notify the borrower within 15 days after the transfer. A 60-day grace period applies where the borrower cannot be charged late fees if payments were sent to the previous servicer. Exam tip: if a test question asks, how long does a borrower have to send payments to the old servicer without penalties? The answer is 60 days. Exam-style quiz questions. 1. When must the loan estimate be provided? A. Within 3 business days of closing. B. Within 3 business days of receiving a completed loan application. C. At least 3 days before closing. D. Within 15 days of loan approval. The LE must be provided within 3 business days of receiving a completed loan application. 2. When must the closing disclosure be provided? A. Within 3 business days of loan application. B. At least 3 business days before loan consummation. C. At the time of closing. D. Within 15 days after closing. Correct answer, B. The CD must be provided at least 3 business days before closing. 3. If a loan servicer transfers the servicing of a mortgage, when must the borrower be notified? At least 15 days before and within 15 days after the transfer. At least 30 days before the transfer. C. Within 3 business days of the transfer. D. The borrower does not need to be notified. Correct answer: borrowers must be notified at least 15 days before and within 15 days after a servicing transfer. 4. When is an initial escrow statement due? A. At closing or within 45 days after closing. B. At least 60 days before loan consummation. C. 3 business days before loan application. D. Only upon borrower request. Correct answer: the initial escrow statement is due at closing or within 45 days after closing. Closing thoughts on Part 2. We've covered key mortgage disclosures and timing requirements, including loan estimate and closing disclosure rules, escrow account disclosures, servicing transfer notices. In Part 3, we'll dive into advertising requirements under TILA and RESPA, mortgage fraud red flags and disclosures, how to explain mortgage terms to borrowers effectively. Episode summary. Welcome back to Episode 5 of the MLO Exam Prep Podcast. In Parts 1 and 2, we covered mortgage loan calculations, LTV, CLTV, DTI, per diem interest, PID, loan estimate, LE, and closing disclosure CD timing rules, escrow account and servicing transfer disclosures. Now in Part 3, we'll explore advertising compliance under TILA and RESPA, mortgage fraud red flags and disclosures, how to explain mortgage terms to borrowers effectively. Let's get started. Mortgage advertising compliance, TILA and RESPA rules. Mortgage advertising is heavily regulated to prevent misleading or deceptive loan promotions. Key advertising rules under TILA. If an ad includes a trigger term, it must disclose additional details. Annual percentage rate APR must always be included if an interest rate is stated. Ads cannot suggest guaranteed approval or no credit check if it's not true. Trigger terms include low monthly payments, must disclose repayment terms and whether payments can increase. No closing costs, must disclose if costs are rolled into the loan. Fixed rate. If an ARM is being advertised, the ad must clarify how long the fixed period lasts. Exam tip. A test question may ask, which of the following advertisements would require additional disclosures? If a trigger term is used, extra disclosures must be included. Prohibited mortgage advertising practices. Bait and switch advertising. Advertising low rates or fees that are not actually available. False no-cost loan claims, implying a loan has no costs when fees are simply included in the loan amount. Misleading comparisons. Comparing loan products in a way that makes one look artificially more attractive. Exam tip: if an ad makes unrealistic or misleading promises, it violates TILA and UDAP regulations. Mortgage fraud red flags and disclosures. Mortgage fraud occurs when borrowers, lenders, or third parties misrepresent information to secure a loan. Common disclosure fraud red flags: undisclosed debts or recent large deposits, falsified income or employment information, inconsistent signatures or altered documents, appraisals with inflated property values. How to handle fraud: if you notice red flags, document them and escalate the issue to your compliance team. Exam tip: a test question might ask, what should an MLO do if they suspect fraud? The correct answer is, report it to compliance and do not proceed with the transaction. Explaining mortgage terms to borrowers. Borrowers often struggle to understand complex mortgage terms. It's the MLO's responsibility to educate them in clear, simple language. Best practices for explaining loan terms. Avoid jargon. Use terms borrowers understand. Use real-world examples. Show how payments will work. Encourage questions. Ensure they fully understand their loan. Exam tip: if a test question asks, how should an MLO explain mortgage terms? The best answer will be clearly, using simple language and real-world examples. Exam-style quiz questions. 1. Which of the following advertisements would require additional disclosures under TILA? A. We offer a variety of loan programs to meet your needs. B. Low fixed payments of $1,200 per month. C. Contact us today to learn about refinancing. D. Our team is here to help you find the right mortgage. Correct answer: any ad that includes a trigger term, like a payment amount, must include additional disclosures. 2. A mortgage ad claims a lender offers no-cost loans. What additional information must be disclosed? Whether costs are included in the loan amount. B. That borrowers must have excellent credit to qualify. C. That the lender is not responsible for third-party fees. That only first-time homebuyers can apply. Correct answer A. No-cost loans must disclose whether closing costs are rolled into the loan amount. 3. What is a red flag for mortgage fraud in disclosures? A. A borrower providing a full 2-year work history. B. An appraisal matching the value of other homes in the area. C. A borrower having multiple large, unexplained deposits in their bank account. D. A loan application with no errors or corrections. Correct answer: C. Large, unexplained deposits may indicate falsified financials or undisclosed income sources. 4. What should an MLO do if a borrower does not understand their mortgage terms? Give them a copy of their loan estimate and move forward. B. Explain using simple language and real-world examples. C. Assume they understand unless they say otherwise. D. Tell them to research loan terms on their own. Correct answer: B. MLOs must clearly explain mortgage terms in an easy-to-understand way. Closing thoughts on Part 3. In this section, we covered TILA and RESPA advertising compliance, common red flags for fraud in disclosures, how to explain loan terms clearly to borrowers. In Part 4, we'll conclude this episode with deep dive on additional disclosure details, final quiz to reinforce key disclosure rules. Stay tuned. Welcome back to the final part of Episode 5 of the MLO Exam Prep Podcast. So far, we've covered mortgage loan calculations, LTV, CLTV, DTI, PI, periodic and per diem interest, loan estimate and closing disclosure timing requirements, escrow account statements and servicing transfer notices, advertising compliance and fraud red flags. Now in Part 4, we'll do a deep dive into additional disclosures and wrap up with a final quiz to reinforce key concepts. Let's get started. Additional disclosure requirements. 1. The Homeownership Counseling Disclosure, RESPA and HEPA. Borrowers applying for federally related mortgages must receive a list of HUD-approved homeownership counselors. Timing requirement. Must be provided within 3 business days of loan application. Exam tip. If a test question asks, which disclosure provides borrowers with homeownership counseling resources? The correct answer is the Homeownership Counseling Disclosure. 2. The Affiliated Business Arrangement, ABA, disclosure, RESPA Section 8. If a lender or real estate agent refers borrowers to a business they have an ownership interest in, they must disclose the relationship. Timing requirement must be provided at the time of referral. Exam tip. If a question asks, when is the ABA disclosure required? The correct answer is at the time of referral. 3. Notice of right to receive a copy of the appraisal, ECOA. Under the Equal Credit Opportunity Act, EOA, borrowers have the right to receive a copy of their home appraisal. Timing requirement. Lenders must notify borrowers of their right to receive a copy of the appraisal within 3 business days of application. The appraisal must be delivered no later than 3 business days before closing. Exam tip. If a test question asks, which disclosure ensures borrowers receive a copy of their appraisal? The correct answer is the ECOA Notice of Right to Receive an Appraisal. 4. The Initial Interest Rate Adjustment Notice, TILA ARM loans only, for adjustable rate mortgages, ARMs, borrowers must be notified before the first rate change. Timing requirement must be provided between 210 and 240 days before the first payment at the adjusted rate is due. Exam tip. For the exam, remember that the initial interest rate adjustment notice must be sent at least 210 days before the first adjusted payment. 5. The subsequent interest rate adjustment notice, TILA ARMs only. For ARMs, lenders must notify borrowers before each future rate adjustment. Timing requirement must be provided between 60 and 120 days before the new rate takes effect. Exam tip. The key difference is that the first adjustment notice must be sent at least 210 days before the change, while subsequent notices must be sent at least 60 days before each future adjustment. Final exam-style quiz questions. 1. When must the homeownership counseling disclosure be provided? A. At closing. B. At the time of loan approval. C. Within 3 business days of loan application. D. At least 3 business days before closing. Correct answer, C. The homeownership counseling disclosure must be provided within 3 business days of application. 2. A lender refers a borrower to a title company that they partially own. What must they provide to the borrower? A. The loan estimate. B. Affiliated Business Arrangement, ABA disclosure. C. The closing disclosure. D. The notice of right to receive an appraisal. Correct answer, B. The ABA disclosure must be provided at the time of referral when a lender has an ownership interest in a referred business. 3. When must borrowers be notified of their right to receive a copy of their home appraisal? A. Within 3 business days of loan application. B. At least 10 days before closing. C. At the time of loan approval. D. At closing. Correct answer, A. Borrowers must be notified of their right to receive an appraisal within 3 business days of application. 4. When must the initial interest rate adjustment notice be sent for an ARM loan? A. 30 days before the first adjustment. B. 60 days before the first adjustment. C. 200 to 240 days before the first adjustment. D. At the time of closing. Correct answer, C. The first rate adjustment notice must be sent at least 210 days before the first adjusted payment is due. 5. How far in advance must a borrower receive the subsequent interest rate adjustment notice for an ARM? A. At least 15 days before the adjustment. B. Between 60 and 120 days before the adjustment. C. At closing. D. After the new payment takes effect. Correct answer, B. Subsequent rate adjustments require at least 60 to 120 days notice. Closing thoughts on Part 4. Key takeaways. Loan disclosures ensure borrowers have full transparency. The homeownership counseling disclosure is required within 3 days of application. The affiliated business arrangement disclosure must be provided at the time of referral. Borrowers must receive an appraisal copy at least 3 days before closing. ARM loan borrowers must be notified of interest rate changes in advance. This concludes Episode 5, Mortgage Loan Origination, Calculations, and Disclosures. In Episode 6, we'll cover loan products and lending terms, conventional versus government loans, fixed versus adjustable rate mortgages, ARMs, specialized loan programs, and guidelines. Thanks for studying with us. You've got this.